Welcome back. So, we were discussing this theorem which is there on your slide. If portfolios A and B are such that in every possible state of the market at time capital T, which is the investment horizon, portfolio A is worth at least as much as portfolio B, and portfolio A is worth more than portfolio B in some states of the world, then at any prior time portfolio A is worth more than portfolio B. We try to establish this theorem by virtue of this example. We have got two portfolios A and B. We take a long position in portfolio A and a short position in portfolio B. The price of portfolio A is PA, price of portfolio B is PB. Because we are long in portfolio A, it will it will entail a cash outflow, and therefore, PA is negative or given a negative sign, and because we are shorting portfolio B, we will get a cash inflow there at time t equal to 0, and therefore, we are taking PB as positive. We assume that in the state alpha, portfolio A gives us a payoff of 10, and in state beta portfolio A gives us a payoff of 100. Portfolio B gives us 0 and 100 respectively, and because the B is short, the payoff would be negative, that is negative of the actual payoff. So, it would be 0 and minus 100. And now, clearly the conditions required by the theorem are satisfied. Portfolio A is as good as portfolio B in all these states, and there is at least one state which is the alpha state in which portfolio A is superior to portfolio B. Now, the payoffs from the combinations of the long and short positions in portfolio A and B respectively, the net payoff is 10 if alpha state arises and 0 if beta state arises. Because there is a positive payoff in one of the states and a 0 payoff in the other state, this constitutes an arbitrage portfolio, and as a result of which the cost of establishing this portfolio must be positive, or the cash, there should be a cash outflow at t equal to 0 for establishing this portfolio. Therefore, PB minus PA should be less than 0, or PA would be greater than PB as required in the or by the theorem. Now, let us look at another theorem. If two portfolios A and B are of equal value today, and if at some future time capital T, that is the end of the investment, A is worth more than B in some world states, then B must be worth more than A in some other world states. I repeat, if two portfolios A and B are of equal value today, and if at some future time capital T, A is worth more than B in some world states, then it must necessarily be that B is worth more than A in some other states. Again, let us try to establish this by an example. We have got two portfolios A and B. We take a long position in portfolio A and we take a short position in portfolio B, similar to what we did just now. And we pay a price for establishing portfolio A. So, PA is negative and PB is positive. If the state alpha materializes, portfolio A gives us 10, and if the state beta materializes, portfolio A gives us XA. And as far as portfolio B is concerned, it gives us 0 if state alpha materializes, and it gives us minus XB if the state beta materializes. Why minus XB? Because we are short in portfolio B. So, while PB is positive, XB will be carrying a negative sign because it is a short position. Now, the net cost of establishing this portfolio is clearly PB minus PA, and this is equal to 0. It is given because it is given that the cost of the two portfolios, or the value of the two portfolios, is the same at an initial point in time or at an earlier point in time at an arbitrary t. Now, the payoff of the combination long portfolio A and short portfolio B is 10 if alpha state materializes, and it is XA minus XB if beta state materializes. Now, clearly, because the cost of the portfolio is 0, the payoffs or the expected payoffs should be 0, or in other words, what we must necessarily have is that and because the payoff in the alpha state is 10, whatever probabilities we allude to, or alpha and beta, howsoever small or large the probabilities of the occurrence of state alpha and beta may be, it must necessarily be that the state beta must have a negative payoff. Otherwise, what will happen is that we will end up with a positive or a negative expected value at t equal to 0 or the earlier point in time, which is contrary to the assumption of the theorem. The assumption says that the prices are identical. So, in this situation it must necessarily be that x a minus x b must be negative, or x a is less than x b, or x b is greater than x a. That establishes the theorem. Then there is another theorem: if P and Q are riskless zero coupon bonds with the same face value and maturity time, if P and Q are riskless zero coupon bonds with the same face value at maturity time t, then they are of equal value at all previous times. This is a very interesting theorem, but a very simple theorem to prove. Let us say we have got two bonds P and Q. Let us assume that the bond P is dearer and the bond Q is cheaper. P is dearer and Q is cheaper. What we do is we construct an arbitrage portfolio consisting of short position in P and long position in Q. Now, because P is dearer and Q is trading cheaper in the market, when we have a short position in P and a long position in Q, the net result is going to be that we have a positive cash flow at that point in time. Whenever we construct this portfolio, at whatever point in time we construct this portfolio, if P is dearer, Q is cheaper, and P is short, Q is long in our portfolio, then we will have a positive cash flow at t equal to 0. Now, clearly the face values of the two bonds are identical, and therefore, because one bond is long, the other bond is short, the maturity payoff of the combination will be 0. The two cash flows that would occur on the date of maturity of the two bonds which coincide will be cancelling each other, will annul each other, and will have a 0 payoff at maturity. Secondly, it is given that both the bonds are riskless bonds. That means what? That means it must necessarily be true that the price of the combination of the two bonds must be 0 at any earlier point in time, and that means what? That means P A must be equal to P B by symmetry. So, it is this theorem is quite straightforward, but it establishes that if there are two risk free, please note the relevance and the importance of the two bonds being risk free, because if they have differing risk profiles, then this theorem would not hold. The theorem holds only because the two bonds are essentially risk free, and therefore, if they have a 0 payoff on maturity, they must if the combination has a 0 payoff on maturity, it must necessarily be that the cost of establishing this portfolio of long and short positions must be 0. So, we are through with this theorem as far as the proof is concerned, and again we get the result from the arbitrage portfolio. Now, nothing an introduction to the subject of security analysis and portfolio theory would not be complete without a reference to efficient markets. So, I will make a quick reference to the concept of efficient markets. I will discuss the relevance or the relationship between efficient markets and arbitrage portfolios briefly at this point in time. We will revisit this particular issue in detail towards the end of this course. So, let us start with a brief review of the postulates of the efficient market hypothesis. There are different forms of the efficient market hypothesis. The form that I am discussing at present is the weak form of the efficient market hypothesis. So, what are the postulates of this weak form of efficient market hypothesis? Let us read them out. The current prices of traded assets encode all the possible information contained in the price history of the asset. The current price encodes all information that is extractable from the price history of the assets. In other words, all the technical analysis that is done to extract information or possibility of future prices, of forecasting future prices, is in some sense, is in relation to this hypothesis absolutely futile. So, what it says is that the current prices encode everything that is knowable by doing anything, doing any kind of analysis of the price history of the asset. Number 2, prices react only in response to fresh information hitting the market. Prices react only if fresh information hits the market. The response, the changes in prices is a response to new information percolating into the market. Therefore, because the new information that is likely to come is not known to the market participants, it can be given the character of random information, and as a result of which the prices follow a random walk under the weak form of the efficient market hypothesis. The dissemination of information throughout the market is instantaneous. This is a very strong assumption, and this assumption has been questioned, and it is absolutely true that it does not hold absolutely in the real world, but this assumption is a part of the postulates of the efficient market hypothesis, that the dissemination of information among the market participants is instantaneous. And then market participants react spontaneously to this new information and take up trades in the market immediately. So, the reaction of the market participants to the new information is also spontaneous. So, on the one hand, the information percolates into the markets instantaneously, and the reaction of the market participants to take up trades in relation to the new information is also spontaneous. And therefore, because of these two factors, market equilibrium is re-established. Once some news enters into the market, some new news flows into the market equilibrium would be disturbed, and because the prices need to realign in the light of new information, and but the process of dissemination of information and the market's reaction thereto is so fast that a fresh equilibrium, a new equilibrium is very rapidly created and established in the market. At equilibrium, all assets are correctly priced. So, the efforts that are made to identify mispriced assets are again futile. And because there are no mispricings, it is impossible to beat the market on a sustained basis. Now, please note here the use of the word on a sustained basis. There may be the occasional situation, because you see we are talking about random processes. So, there may be the occasional situation when you call heads and the market gives you heads. In that situation, you may be making a profit, but on a sustained basis, if you continue to call heads, it is very unlikely that you will end up making a profit out of your strategy. So, that is what the market says, that is what this efficient hypothesis says, that because there are no mispricings, you may, but although there are no mispricings, the process followed by prices are random, and therefore, there could be situations where what you call turns out to be correct and you make a profit, but there would also be situations where what you call is not returned by the market, and as a result of which you end up making losses. So, on a sustained basis, it is not possible to beat the markets. This is the inference of the efficient market hypothesis. Now, what is the relationship between efficient market hypothesis and arbitrage? Now, on the one hand, one can straight away say that if the markets are absolutely efficient and all assets are correctly priced at all points in time, then there is no possibility of arbitrage in the market. But at a realistic level, when we talk about real markets, the flow of information, at least the flow of information, percolation of information in the layers of the market participants is not spontaneous, it is not instantaneous, it takes a finite amount of time. And therefore, during that finite amount of time at least, there could be mispricings prevailing in the market, which would give arbitrageurs the opportunity to come into play, and then it is the role of arbitrageurs, the trades that they take up in order to extinguish the mispricings that arise from the slow or the finiteness of time in the percolation of information in the market, to neutralize the discrepancy between the correct price and the mispriced situation or the mispricing of the assets, so that these mispricings are completely evaporate from the market, and the market again returns to an equilibrium where all assets are correctly priced in the market. So, in a nutshell, the conclusion is that faster the arbitrage, more is the increase in efficiency, the more rapid the arbitrage takes place. If there is any mispricing at any point in time, the faster the arbitrage process comes into play, and the more rapid the volume of arbitraging, the more rapid would be the returning of the market to an equilibrium of correctly priced situation, and therefore, the market should increase in efficiency. And on the other hand, greater the market efficiency, the more rapid would be the percolation of information, the lesser chances would be there of assets being mispriced in the markets, and as a result of which fewer will be the arbitrage opportunities. Now, we talk about this is all that at the moment I would like to discuss about the introduction to the subject. It has been an extended introduction, but this will help us when we take up each of these topics in detail in later segments of this course. So, let us now talk about securities market segmentation. Markets may be segregated into primary and secondary markets. Primary markets are those markets in which the issuer himself or itself markets the securities, and the investors take up the positions in these securities directly through an issue by the issuer of the securities. So, the issuer of course can be a body corporate issuing shares or debentures or bonds, or it could be government issuing the bonds or debentures. Primary markets are basically a marketplace where there is interplay between the issuer himself or the issuer of the securities itself and the potential investors in the instruments which are issued by the issuer. In the secondary markets, it is the existing securities that are traded, securities which have been taken up by the investors either in the primary market or through other secondary market trades can be traded in these secondary markets. So, primary markets when you take up securities directly from the issuer, and secondary markets when the trading is done by between parties which hold the securities through the issuer in the primary market, or other parties who have taken up securities from parties who got it in the primary markets. Okay. So, now we can also, this is one form of market segmentation. We can also do market segmentation by types of instruments. For example, we can talk about money markets, which are short term markets, we will come back to it. We can talk about capital markets. Capital markets involve bond markets, they involve equity markets, and then we also have markets in which derivative instruments are traded, like the futures and options segment in the National Stock Exchange NSE and the BSE. So, we are talking about money markets. Money markets are short term markets. Short term markets in which trading is done for overnight as well as short term lending and borrowing, and trading of short term debt instruments with maturities of 1 year or less. So, money markets are basically markets in which money trades take up, that is lending and borrowing takes up, or instruments are traded which have maturities of less than 1 year, and this money market is regulated by the Reserve Bank of India, by the RBI. The major participants in the money markets are the Reserve Bank of India, the commercial banks, financial institutions, foreign institutional investors, mutual funds, brokers, and large corporate houses. Individuals are also allowed to participate in money markets, but the role of individuals is not very significant in these types of markets. The types of instruments that are traded on the money markets. Well, we have reasonably large spectrum now of instruments that are traded in the money markets. We have treasury bills, we have cash management bills, we have call money markets, where which is an interbank market where short term exchanges of money take place. We will come back to it. Certificates of deposits, commercial paper, commercial bills, collateralized borrowing and lending obligations, CBLO, that is they are called repos and reverse repos, and we also have swaps. Now, before we take up these instruments in detail, it is important to discuss the nuances of money markets in terms of the measures of yield that are frequently employed in the money markets. So, in the money markets we have two types of instruments traded. Number one, discount instruments, where instruments are issued at a discount to face value and are redeemed at face value. I repeat, the instrument is issued at a discount to face value and is redeemed at face value. So, basically the difference between the issue value, which is at a discount to face value, and the face value, which is the value at which the instrument is redeemed, constitutes the return to the investor. And the other is the traditional instrument, which is the instrument which is issued at face value and then redeemed at face value with or above face value, that is at face value plus the interest for the period of issue. So, basically we have two types of instruments: discount instruments issued, which are instruments which are issued at a discount, redeemed at face value, or instruments which are issued at face value and are redeemed at a value above face value, that is the redemption is at face value plus the interest for the holding period. Now, the most common measure of yield in the money market is what we call the banker's discount yield, or the BDY, or simply the discount yield, or we also call it the T-bill yield. The measure or the formula for obtaining this yield is given at the bottom of the slide. And there are certain very important features about this particular measure, which make it considerably different from the traditional yield measure that we are accustomed to in the longer term markets like the bond markets or equity markets. The first feature is that if you look at this formula carefully, the normalization of the discount is done with respect to the face value. It is not with respect to the value of the investment. That is, it is not at the value that at which you take up the instrument, it is at the value that you receive at the end of the instrument. Almost all measures of yield, all measures of return use the investment price, investment value as the normalizer for calculating the return when we want to work out the return per unit of money. So, we divide it by the initial investment to arrive at the return per unit of money. Here the division is done with respect to the face value. So, the value of the discount is expressed as a percentage of face value, not as a percentage of the initial investment. Number 2 is, if you look at this figure 360. So, again the normalization with respect to time, the conversion of the yield to the annual yield is done with respect to 360 days year, not 365 years, which is the convention in the bond markets and the longer term instruments. So, this is the second feature. The first feature, the normalization with respect to money, with respect to investment, is with respect to that face value, not with respect to the initial investment. Number 2, the normalization with respect to time is with respect to a 360 day year, not with respect to 365 day year. And the third important feature is that it is quoted on a simple interest basis. There is no compounding involved in the calculation of this yield. So, these are three salient features, three nuances of the banker's discount yield, which set it apart from the other measures of yield that we are going to talk about, or the other measures of yield that we usually encounter in long term investments. Then we have the holding period yield. Now, the holding period yield is significantly different from the discount yield. The first difference is that the normalization is done with respect to the initial investment. As you can see here, the denominator is P0. P0 is the amount or the price that you pay for entering into the investment, for taking up the investment. It is the initial price. That is the way in fact it should be. That is your cash outlay on which you are earning the return. But this feature is superseded by the T-bill yield or the discount yield. In the holding period yield, that is not so, it is correctly used. The investment the investment uptake price, that is taken as the normalizer for working out the per rupee or the per unit of money yield. The second thing is that the second problem with this yield is that there is no normalization with respect to time. In fact, holding period yield is the return or the yield over your holding period. This is the actual yield over your holding period. It is not on a per annum basis, it is not on a per annum basis. It is calculated on the basis of the period for which you actually hold the investment. And number 3, it also obviously it should include other cash flows on account of interest or dividend that accrue to you during the holding period. So, it is basically the total value including cash inflows on account of interest, dividend or as the case may be, plus the closing price or the price at which you exit the investment minus the initial price divided by the initial price. But please note this important flaw with this yield, that it is not normalized with respect to time on a per annum basis. Now, this is the most common form of yield, the effective annual yield. This does away or this eliminates the shortcomings of both the holding period yield and the banker's discount yield or the T-bill yield. The formula, as you can see here, the formula is involves normalization with respect to 365 days. The formula involves normalization with respect to money in terms of the initial investment. So, that is also taken care of. It is not at face value, it is at initial investment, and the normalization is with respect to 365 days. And thirdly, the yield involves compounding also. So, that flaw of using simple interest is also done away with in this particular form of yield. Then there is another measure of yield which is exclusive, as in case the banker's discount yield also, which is also exclusive to money markets. The money market yield is similar is an annualized form of holding period yield. It is the annualized version of holding period yield. However, the annualization is with respect to 360 days, which is similar to the T-bill yield. So, while the effective annual yield is also annualization of holding period yield, but it takes care of the compounding as well as of the 365-day year. In this case, in the case of money market yield, we extrapolate the yield to the per annum basis by using a 360-day year. And secondly, just like the T-bill yield, this is also a yield that is based on simple interest that involves no compounding. This slide gives you the relationship between money market yield and the banker's discount yield. The derivation is quite straightforward. I will not go through it step by step, but it is simple algebra. So, you can easily work it out. The money market yield is equal to banker's discount yield into 360 divided by 360 minus banker's discount yield into the holding period. Then this slide gives you the relationship between the banker's discount yield and the effective yield. This is a very important formula, but again the working is quite straightforward, simple algebra, nothing more. The banker's discount yield is given by P1 minus P0 upon P1 into 360 upon NSM. NSM is the holding period. From this we obtain the value of P1 upon P0 as the expression that is given in the right hand corner, upper corner of your slide, and the effective annual yield is given by P1 upon P0 to the power 365 upon the holding period -1, which gives you the final result here on the bottom of your slide. Let us take up an example. An investor buys a $1,000 face value T-bill due in 60 days at a price of $9.90. An investor buys a 1,000 face value T-bill due in 60 days at a price of $9.90. The banker's discount yield is quite straightforward, 1000 minus 990 divided by 1000. Now, this is important, divided by 1000 into 360 upon 60. This 360 is the second feature, and the third feature is that there is no compounding, as you can see from the formula. So, you get the result of 6% as the banker's discount yield, or simply the discount yield, or the T-bill yield. Then we come to the holding period yield. In the holding period yield, there is no annualization. So, we have 1000 minus 990 divided by the price of entry, that is 990, that gives you 1.0101%. But please note, this is the yield over 60 days, it is not the annualized yield. Then the effective annual yield is the correct measure of yield, I may venture to say, and this is worked out on the basis of P1 upon P0 to the power 365 upon n minus 1, and that gives us 6.3047%. As you can see here, the difference between the banker's discount yield is, which is 6%, and the effective annual yield, which is 6.3047%, there is a significant difference between them, and although both are annualized, the issue is one of compounding, and then the second is the number of days that are the day count method, the day count approach, that is different in both cases, as a result of which the effective annual yield turns out to be more than the banker's discount yield. And the money market yield, as the annualization is with respect to 360 days, but it is annualized and it gives us 6.06%. But please note here the denominator, or the normalization with respect to money, is with respect to the initial investment, the entry amount, and therefore we get it as 6.06%. Here the denominator is 990, while when we work out the banker's discount yield, the denominator is 1000. Another example here, we have a treasury bill of the face value of 100, and it has a tenure of 60 days remaining, and it is quoted at 99. We need to calculate the various yields. It is quite simple. The discount yield is given by P1 minus P0. P1 is 100. P1 is 100. Yes, P1 is 100. P0 is 99. P0 is 99 divided by 100 into 360 divided by 60. The effective yield is given by 100 divided by 99 to the power 365 upon 60 minus 1, and the bond equivalent yield we will talk about when we discuss the long term bonds, or the bond valuation and so on, which would be our next topic. Then thank you.